Hello, everybody. Dr. Phil here. So this is corporate reporting and analysis. Let's jump into it. So, what is a corporation? Why do you hear so much about corporations? A corporation is an entity that's created by law. One of the key things is its existence is separate from owners. Existence is separate in the sense that the corporation is its own. It's going to sound funny, its own legal person. So it can sign contracts, it can take out debts, it can be sued, but it's a good form of ownership in the sense that it subjects the owners, the shareholders, to limited liability. It has rights and privileges, like I say, it can form contracts, it can take out debts, um, it can buy things, so on and so forth. Now, the ownership can be privately held. So think about that like just if you maybe like you start a company and sometimes we'll call instead of calling it privately held, we may call it that, but we could also say closely held. Imagine you set up a company and you're like, I just want to get some friends in on it, some people I know. So that's what you do. So you and your friends own it. That would be an example of privately held or closely held. Now, a lot of times companies start that way, but then you sort of like you run out of people that have money and you need more. So you say, well, I don't have enough friends that have enough spare cash. So the only way I can really scale this business even more is I need to take it. That's where we come to the term taking a company public, going from privately held to publicly. You don't have to be privately held first. You could be publicly held from the inception of your business, but it's more typically the case that they would be privately held first. So characteristics of corporations, some advantages. Like I said before, it's a separate legal entity. This is a really key one, limited liability. The ownership rights can be transferred, i.e. one person can sell their stock to somebody else. You can immediately buy it. It's easy to do. Continuous life, the company never really ends. It just keeps going in perpetuity. Um, there's no mutual agency for stockholders. You're just a stockholder. You don't have any liability above. The most you can lose is the extent of your investment. And easier capital accumulation through retained earnings. A couple of disadvantages. There is a lot of government regulations for corporations, and when we say corporations, we're talking about C corporations. And there is an issue with corporate tax in that the income is taxed, and then when the dividends are distributed, they are then taxed at the individual level. So this is kind of how a corporation is set up. You've got your stockholders, they are of course the owners. That could be people like us, it could be pension funds, mutual funds, so on, anybody really that's got the money to buy the stock. Um, so the board of directors reports to the stockholders. The board of directors are responsible for hiring what we call the C-suite. So think about like the CEO, CIO, CAO, COO, so on and so forth. And then, of course, at the bottom of the pyramid, the employees of the corporation. So the rights of stockholders. So if you are a stockholder, you have a right to vote at the stockholders meeting. Now that's true, but it's also not. It's only true if you have common stock. If you have preferred stock, you don't typically get a vote with preferred stock. You get a vote with common stock. Um, you can sell or dispose of the stock. You can just sell it to somebody else. There's a whole secondary market for stock for equities. Purchase proportional additional shares of stock. So, like if a company issues more shares, then they are usually required, almost always bound to offer you the extra shares that will keep your ownership in proportion to what it was before. You can certainly receive dividends if they declare. Now, one common misconception about dividends is that companies always pay them. They don't. You could go your whole life or your whole existence as a corporation, never pay dividends. You might pay them straight away. Most newish companies don't because they want to kind of keep plowing that money back in to sort of grow the company. And then number five, sharing any assets remaining after creditors and preferred stockholders are paid in a liquidation. So a liquidation is basically the business is gone into administration, it's going bankrupt, it's going under. Um, so one of the benefits as a stockholder, it's not, they make it sound like it in number five here that it's a great benefit. It's really not because you're sort of way down the queue, the line of people with their hands out saying, hey, you're going bankrupt, you got to pay me. Um, in many cases, there's little to nothing left for the stockholders. So here's an example of a stock certificate. You don't really have to commit this to memory because every company is going to have their own version of this. Each unit of ownership is called a share of stock. You probably knew that. And a stock certificate proves was your proof that you own the stock. Now, in this day and age, no one's going to mail you anything. I mean, they might email you something like a PDF that proves your ownership, and they'll have a record of it too. So the basics of capital stock. So just some terms that it's good to know. Authorized stock is the number of shares that a corporation's charter allows it to sell. So when they first set up the company, they will have said, okay, well, in the life of this company, this corporation, we will never issue more than this amount. So that's the authorized amount. The par value stock is the amount that's assigned per share. This goes back to a British custom a couple of hundred years ago, where the UK government basically said every share of stock, regardless of what it's trading for on the market, on the equities markets, has to have a value, just something. So a lot of times the par value is 0.001 cents, just because they have to give it something. You can also have no par value stock, so there is no value assigned to it, uh, but of course there's still market value. And then stated value stock, no par stock that has an assigned stated value per share. So stockholders' equity is basically consists of two things. You've got your paid-in contributed capital. That's going to be, your common stock, preferred stock account. So think about that like money that people kicked in. And then number two is retained earnings, the money that the business has generated through operations. All right, so par value versus market price. This is worth understanding because a lot of people get these confused. So par value, notice it says it's an arbitrary amount, so it's just really, we're setting up a company and we're like, oh yeah, we have to have a par value. So what do we want to do? Do you want to do a cent, 1 cent per share, 0.01 cents per share, 0.001 cents per share? It can be whatever we choose. And then the market price is just the amount that it's trading for on the open market. So stockholders' equity, again, is going to consist of paid-in capital. That's going to be your common stock, and then what we call paid-in capital in excess of par. And then any retained earnings, again, are indicative of the company is now operating. It's generating money at the end of each period. It's kind of saving money up. Think about what the word retain means to keep the earnings in the business. All right, so issuing par value stock at par. So let's look at an example. So this one's fairly straightforward. So it says on June the 5th, Dillon Snowboards Inc. issued 30,000 shares of $10 par value stock for $300,000. So let's record the transaction. So all they're going to do here is they're going to debit or increase the asset account cash, and they're going to credit or increase the equity account common stock. You could put $10 par value. You probably wouldn't actually put that there. In the amount of 300,000, right? So they just issued it for par value. The par value is $10 per share. So then 10 times 30,000 is your 300,000. So what about if you issue par value stock at a premium? This is of course what you hope for, right? Because when you first issue stock, you want the price to be as high as possible. So let's say that now they issue 30,000 shares of $10 par value stock for $12 per share. So think about this. $10 of that value is par. The extra 2 is the premium. Okay. So now the company's going to get 360,000, right? So think about it. 12 times the 30,000, there's your 360. So they're increasing the asset account cash to reflect the money coming in. And then common stock is only going to go up by the par value. So the important thing to understand, to note, to remember about the common stock account is it only accounts for par value. That's it. So there has to be somewhere else to account for all the extra money that you get over and above par value. Right? So like in this example, they got an extra $2 per share. 30,000 times 2 is your 60,000. So think about why the name of this account makes sense. Paid in capital in excess of par value. Par value was 10, they sold it for 12. So they basically got an extra $2 per share. So paid in capital in excess of par value, this account is where we're basically capturing everything over and above the par value. So issuing par value stock. So like in this example, we had 300,000 of common stock, $10 par value, 30,000 shares issued. Now there's 50,000 authorized, but that's just the amount that they can. That's like the maximum they can issue out. But they've only issued 30,000 out, so you could think of it like they've still got 20,000 that they could issue out if they chose. Paid in capital in excess of par is that 60 we just talked about. They also have retained earnings of 65. You didn't have to calculate that; they just gave it to you. So that's like 65,000 that the business has generated in operations, that they've kept in the business that haven't paid out to shareholders in the form of dividends. So they have total stockholders' equity of 425,000. So what about issuing no par value stock? So on October 20th, Dillon issued 1,000 shares of no par value stock for $40 per share. So let's record this one. So again, they're just going to debit or increase the asset account cash, and they're going to credit or increase common stock no par value in the amount of 40,000. So this one is fairly straightforward. What if they have stated value stock? So on October the 20th, Dillon issued 1,000 shares of $40 stated value stock for $50 per share. So again, you can see $40 stated value, but they're basically they've got an extra $10 for each share, right? Because stated value is 40, but they're getting 50. There's your extra $10. So let's record this transaction. So cash is going to go up by 50,000. So they're going to debit or increase the asset account cash. They're going to increase with a credit the equity account common stock for 40 grand, and then they are going to increase or credit the another equity account paid in capital in excess of stated value. So what about issuing stock for non-cash assets? So this is more of a this is something that's not actually going to involve any cash directly. It's sort of like trading one asset for another. So it says on June 10th, 4,000 shares of $20 par value stock is given for land valued at 105,000. So they're going to debit land, they're going to increase, if they didn't have one already, they would set up an asset account, call it land, debit or increase that for 105. And then common stock, $20 par value, that's the $20 par value times 4,000 is your 80. And then the difference between what they issued out in par value and the value of the land, the extra 25,000, that's going to be sent to that paid in capital in excess of par value. So what about issuing stock for non-cash assets? So on June, another example, on June 5th, 600 shares of $15 par value stock is issued for 12,000 of organizing work. So maybe like an accountant, auditor, lawyer, those types of things. So the debited organization expenses, this is just going to get expensed out straight away. They're going to credit common stock again for the par value. Remember, it's always the common stock account is always just getting that par value. And then the extra in this case, the extra 3,000 is going to be credited to paid in capital in excess of par value common stock. All right, cash dividends. So these provide a return to investors and almost always affect the stock market's value. So usually if a stock is paying dividends, the value will be a little bit higher because the analysts are factoring in the present value of future dividends. So in order to be able to pay a cash dividend, the corporation must have, number one, a sufficient balance in retained earnings, obviously, and number two, the actual cash necessary to pay the dividend. So there's really, when it comes to dividends, there's really three important dates you got to know. So we have the date of declaration. That's when the board of directors said we are declaring a dividend on this date. That is, once they declare it, it becomes a legally binding obligation. So on that date, they record the liability for the dividend. The date of record is the date of record, there's no entry required on that date. That just means that as of, let's say that we declared the dividend on, September the 15th. And then let's say that we said that we're going to pay it as of the last day of September. So like basically, 2 weeks, half a month later. Whoever the stockholders are, because remember, the stockholders change all the time. People are just constantly buying and selling, right, in those secondary markets, in those secondary equities markets. Whoever owns the stock on that date is who we're sending the check to, right? So even if they technically sold it like the day before and we just didn't know, then the old person is still going to get the check, right? And we sometimes call that right after is the ex-dividend date. And then finally, the date of payment is the date that they'll actually go ahead and pay it. So let's take a look at an example of the accounting for cash dividends date of declaration. So on January 9th, a $1 per share cash dividend is declared on ZTEC Inc.'s 5,000 common shares outstanding. The dividend will be paid on February 1, so about a month later, to stockholders of record on notice of record on January 22nd. So whoever owns that stock on January 22nd is who's getting the check. So that we record the liability for the dividend. Because remember, on that date, it's a legally binding obligation. So they're going to debit retained earnings for 5,000. They're going to now retained earnings is an equity account, normal credit balance. Well, you want to make your retained earnings go down a little bit, right? Think about why. Because money is going to be paid out. So we're going to debit or decrease retained earnings. We're going to credit or increase the liability account, common dividends payable. Also, it would probably just say dividends payable. On the date of payment, there's no entry required on the date of record because, again, that's just like, as of this date, these are the people who will get the check because that's who our list says owns the stock. All right, so on February 1st, when they pay it out, they're just going to lower common dividends payable. They're going to decrease this liability account and they're going to decrease cash. Remember, cash asset account, normal credit balance. You want cash to go down. Why? Because money's going out. So we're gonna credit cash for 5,000. Now, do they always pay cash dividends? No, sometimes they'll pay stock dividends. So you can think of a stock dividend as a distribution of a corporation's own shares to its stockholders without receiving any payment in return. So why would a company choose to do this? So one thing it does is it keeps the market price of the stock affordable because it doesn't flood. It kind of helps with, like, think about like the supply and the demand of stock. It also shows management's confidence that the company is doing well in the sense that if they're willing to give you stock dividends, the assumption is that, hey, this is of value to you because these are going to go up in value in the future. A small stock dividend distribution is generally, so this is less than or equal to 25% of the previously outstanding shares. And then if it's over 25%, we would call that a large stock dividend. So let's talk about recording a small stock dividend. So this company, Quest, has 10,000 shares of $10 par value stock outstanding. On December 31st, Quest declared a 10% stock dividend when the stock was selling for $15 per share. The stock will be distributed to stockholders on January 20th. So let's make the December 31st entry. So we're going to do a couple of things here, a couple of calculations. We're going to capitalize retained earnings for the market value of the shares to be distributed. So 10,000 shares multiplied by the 10%, there's your 1,000, and then times 15 because it was selling for $15 per share equals 15,000. So that is the value that we need to lower retained earnings by. And then we're going to credit common stock dividend distributable. You can think of that as a liability account, and then we're also going to credit the equity account for the difference, the extra 5, for paid-in capital in excess of par value common stock. So stockholders' equity, as far as like how this would look, if you look at before the dividend and look at after, the first thing I'll draw your attention to is notice that they're both equal 143. Right, before the dividend, they had 100,000 of common stock. They had 8,000 in excess, paid-in capital in excess of par. They had 35,000 in retained earnings. And then if you look at the date of declaration, they increased 10,000 because they're gonna issue 10,000 shares out. Now the value of those shares was 15,000, so they're basically adding 5,000 to the excess of par value account. So they're going to need to lower their retained earnings by 15,000. On the date of payment, common stock is going to go up by 10. Distributable is going to go down by 10 because now it's gone into effect. After the dividend, they've now got 110,000 of common stock. But what they've done is they've taken away, they've basically taken that out of their retained earnings balance. All right, so this is an example of the journal entry. All this information appears the same. So they would on January 20th, they would debit or decrease common stock dividend distributable, and they would credit common stock. So they're basically saying, okay, now we're taking it out of where it was going to be distributed. Think about the word distributable, future tense. It's now being done. So now we're adding it to the common stock account. All right, what about recording a large stock dividend? So Quest Inc., they have 10,000 shares of $1 par value stock outstanding. On December 31st, last day of the year, Quest declared a 30% stock dividend. The stock will be distributed to stockholders on January 20th, 2021. So let's go ahead and do the year-end entry. So the first thing we'll do is we'll capitalize our retained earnings for the minimum amount required by state law, which is going to be that par value. So 10,000 shares times the 30% that they gave us up here, it's going to be 3,000 shares, $10 par value, so it's 30,000. So they're going to debit or decrease retained earnings for 30,000 because it's going to be taken out of retained earnings. And they're once again going to credit the common stock dividend distributable account. All right, next thing, stock splits. Maybe something you've heard of, maybe not. Either way, it's fine. This is just a distribution of additional shares of stock to stockholders based on their percent ownership. Now, I'll dispel a common rumor, common myth here that a lot of people think if they own stock and it splits, they've doubled the value of their shares. It's not the case. The value hasn't really changed. It may change slightly, and I'll explain that more in a second. So let's say that you had 100,000 shares at $20 par value. So think about like 100,000 times 20 is $2 million of common stock. If they do a 2-for-1 stock split, you've now got 200,000 shares. So look what happened to the number of shares. It doubled, but look what happened to the value. It halved. So if you think about it, you are no better off than you were before. The only way you may now be better off is because more people can now afford $10 than could afford 20. So then you'll sometimes see a slight increase in the value. So if you make any gains, that's where they're going to come from. All right, issuance of preferred stock. So if Dylan issues 50 shares of $100 par value preferred stock for $6,000 cash, the entry would be as follows. So they're getting cash, so they're going to debit or increase the asset account cash. They're going to credit preferred stock, $100 par value, in the amount of 5,000. That's the par value, right? 50 shares of 100, or 50 shares times 100, excuse me, I should say. And then paid in capital in excess of par, that's going to be the difference, right? The extra 1,000. And then the equity section of the year-end balance sheet, this is how they would present it. You just look at what's in red. You got the preferred stock of 5,000, and then you have the paid in capital in excess of par value preferred stock. That's the extra 1,000. All right, so reasons for issuing preferred stock. So you notice the first point says to raise money without sacrificing control. So let me cast your mind back to something I said earlier in the video. Common stock, you get votes. Preferred stock, you do not. So if they want to issue stock, they want to raise money without giving away ownership and potential votes, then they would do so by issuing preferred stock. To boost the return earned by common stockholders through what we call financial leverage, we'll talk more about that in a bit, and to appeal to investors who may believe the common stock is too risky or that the expected return on common stock is too low. So dividend preference of preferred stock. There's really two ways this can go. You can have cumulative or you can have non-cumulative. Okay, so if it's cumulative, any dividends in arrears. So the term in arrears, just think of that as dividends that they've declared like in previous years or previous financial periods that they haven't paid. They have to be paid before dividends can be paid on any common stock. Okay. If they are non-cumulative, then any undeclared dividends from current and prior years do not have to be paid in future years. So you're better off if you have preferred stock. It's better to have cumulative because that means in previous years, if they've declared dividends and they haven't paid you yet, they have to pay you before they can pay any common stockholders. So as an example of dividend preference of preferred stock. So take a look at the stockholders' equity sections, cumulative on the left, and then non-cumulative on the right. Right. So it says the board of directors declares 5,000 of dividends in year one, and then in year two, the board declared and paid cash dividends of 42. Okay. So in year one, preferred gets 5. You can see it's 5 in both. Now in year two, step one, we have dividends in arrears of 4,000. Right. The current year's preferred dividend is gonna be 9, and then the remainder to common would be 29,000, right? Now, if you compare that to non-cumulative, in year one, the preferred was 5,000. Notice that it's 9,000 here, just like you see over there. But notice what's happening over here. Like they're not basically saying, oh well, we had amounts from previous periods, we have to pay. So, on the left, that's what they're doing. Non-cumulative, they're not doing that. If you didn't get paid it in the previous year, I mean they could still pay it to you, but they're not legally obliged to do so. This is why it's better to have cumulative stock. Okay, treasury stock. So these represent shares of a company's own stock that has been acquired. Basically, think of it like the corporation issued them out and then purchased them back. Why would they do that? Because that's less stock outstanding. That's less votes that may, that people who may vote against you or not, not for things that you want to do. It also cuts down your dividend cost. So a corporation might acquire its own stock to number one, use its shares to buy other companies. That's possible. Number two, avoid a takeover of the company. The less shares outstanding, the less of your company is available to be purchased. Number three, they might reissue to employees as compensation. So yeah, sometimes companies will have what we call ESOPs, ESOP, employee stock option plans. And then so that'd be one example. And then maintain a strong market in the sense of if there's less of your stock outstanding, if demand is, or excuse me, if supply is low, demand is higher, so therefore price is higher. So let's take a look at an example of purchasing treasury stock. So on May 1, Cyber Inc. purchased 1,000 of its own shares of stock in the open market for 11.50 a share. So we're just going to take the 1,000 shares times 11.50. There is your 11,500. They're going to debit treasury stock common for 11.5. They're going to credit cash because they're having to pay out cash in order to purchase these common shares. So treasury stock, excuse me, is shown as a reduction in total stockholders' equity on the balance sheet because it's no longer equity outstanding. You purchase it back. What if we sell treasury stock at cost? So let's take a look at an example of that. So on May 21st, Cyber sold 100 shares of its treasury stock for 11.50 a share. So they would just simply increase cash by 11.50 because they're receiving 1,150, and then in return they're giving out. They're basically reissuing treasury stock back out. So they're going to issue treasury. They're going to credit treasury stock common to basically reverse what they did before. What if you sell it above cost? So this example says on June 3rd, Cyber Inc. sold an additional 400 shares of its treasury stock for $12 per share. So here, you can think of the 400 times 12, 4,800. So they're going to debit or increase the asset account cash by 4,800. They're going to credit treasury stock common. And the way that they're getting that, if you do the 11.50 times the 400, that's going to give you the kind of the par, if you will. And then the paid in capital treasury stock is going to account for, as you can see down here, for the difference. So 4,800 is total. That's 400 times 12. But the 11.50 is, you can think of that as the par value. Thus, the extra paid in capital is 200. What if they sell below cost? Hopefully this doesn't happen, but you know what? Maybe it does. So on July 10th, Cyber sold an additional 500 shares of its treasury stock for $11.20 per share. So now what they're going to do is they're going to increase cash. They're going to receive 5,600, right? So you can think of that as the 500 times the 11.20. They're going to debit paid in capital treasury stock. That's the 150. That's going to be the difference between the cost and the sale. Now we know if you look at the treasury stock common, that was the cost. The 500 times 11.50 is going to give you the credit to treasury stock common of 57.50. All right, statement of retained earnings. So retained earnings is the total cumulative amount of reported net income less any net losses and dividends declared. So just think of that as the money they've built up in the business over time, over like many financial periods typically. Now we can have what we call restricted retained earnings. And this could be two types. It could be legal or contractual. So if it's a legal restriction, most states restrict the amount of treasury stock purchases to the amount of retained earnings. So you can't go over the amount that you have in retained earnings. And we may also have contractual restrictions. So for example, loan agreements can include restrictions on paying dividends below a certain amount of retained earnings. One of the last things we'll talk about in this video, prior period adjustments. So these are corrections of errors, typically material, as in material being like it had an impact on some of the numbers in past years' financial statements that result in a change in the beginning balance of retained earnings. So you can see here we got a prior period adjustment. The cost of land incorrectly expensed net of $60 of income tax benefit. So they have a prior period adjustment of 200. So they're just kind of factoring that into the current period's retained earnings. So this is an example of a statement of stockholders' equity. You've kind of got your major components on the top: common stock, paid-in capital in excess of par, retained earnings, treasury stock, and then whatever your total. So you're kind of just adding them from left to right. And then if you look at your ending, you've got your ending balances for the respective components. Yeah, as you work your way down vertically. So for example, like retained earnings, beginning balance was 50 grand. It was increased by 30,000 of net income. It was decreased by 8,000 being paid out for cash dividends. So think of it like 50 plus 30 minus 8 gives you the 72. Okay, almost done. Earnings per share, EPS. So this is a very widely um, promulgated and published metric. It's very popular in the accounting and finance literature, and certainly in the investing world. So the calculation, basic earnings per share, what we call BEPS, is just net income minus any preferred dividends that were paid, if any were, and then divided by the weighted average common shares outstanding. And then the other ratio, I just want to mention real quick, what we call the PE ratio, price earnings ratio. So this just tells you something about the stock market's expectations for a company's future growth in earnings, dividends, and opportunities. So the PE ratio is just the market value, the current price per share, divided by the earnings per share. So like how many times does the earnings go into um, the market value? All right, that's it for this video. Thank you as always for watching, and see you all soon.